Hello there. Welcome to yet another episode of our discussion about stocks. Here, we will show you the 7 distinctive companies a la Buffett. As always, we guide you through stocks that are high-yielding in dividend, stable, and consistent. Are you looking to diversify your investment and considering investing in stocks? Then hop in here. We have helpful information that will guide you about stocks. According to the legendary investor Warren Buffett, he advised investors to put their trust and capital in companies with sustainable competitive advantages. He said there are 2 kinds of competitive advantages, and the first is the company is the cheapest producer, for example through economies of scale or have a better business model. Secondly, whether it has the strongest brand which consumers are willing to pay for. Let's delve deeper into our discussions about the stocks of the 7 distinctive companies a la Buffett. If you're enjoying this video already, hit the thumbs up icon to like it. Please don't forget, hit the bell icon to subscribe to this channel if you haven't done so already. Now, let's begin. Number 1. eBay. eBay was established in 1995 in San Jose City of California, USA. The global e-commerce platform facilitates consumer-to-consumer and business-to-consumer sales through its websites and also owns the Dutch marketplace. It facilitates over 2% of the global online trading market, having its business operation in about 32 countries of the world as of 2019. It accrues $10.8 billion in 2019 and has a total asset of $18.17 billion, with a net income of $1.8 billion. The company reported its first quarter results on April 28. Earnings per share were up 59% from the previous year, and sales hadn't grown quite that fast since 2005. The share was higher than ever in April, and the expected price-earning ratio is 15.04, which is lower than the average U.S. stock. At a price below $60, we see a good risk-return profile for long-term investors. The company pays a quarterly dividend of 18 cents per share and an annual dividend of 72 cents per share. It has a current dividend yield of 1.11% and a price-to-earning ratio of 16.16. Number 2. Bank of America. Bank of America is the second largest financial institution in the United States after J.P. Morgan Chase, with more than $2.9 trillion under management. It was founded in 1998 and headquartered in Charlotte, North Carolina. It generated revenues of $73.75 in 2020, with a decline of 17.46% from 2019. This is partly due to the effect of the global pandemic, which leads to economic crises all over the world. In the first quarter of 2021, the bank reported a doubling of earnings per share. While low interest rates remained a challenge, progress in resolving the corona crisis is positive. We think the recovery is picking up faster, said CEO Brian Monahan. Bank of America stock is up more than 42% in the past year and recently hit a multi-year high. The share-to-price earnings ratio stands at 15.2, which is comparable to that of ABN AMRO. However, we think a drop to $40 is a good entry point. Still, if the economy continues to improve, an increase is more likely. It pays a 18 cents per share quarterly dividend and an annual dividend of 18 cents per share with a dividend yield of 1.8%. It currently has a price-earning ratio of 17.86. Number 3. Blackrock. National company founded in 1988 and headquartered in New York City, USA. Blackrock is the largest asset manager globally with more than $9 trillion under management in the first quarter of 2021. It reported a 16% increase in net incomes for the first quarter than the year before, $1.2 billion. And BlackRock not only manages more money than in the previous year, but it also makes more money from it as commissions were up 14%. Analysts and investors agree that these are impressive results. The stock is at a record high and the expected price-to-earning ratio is 23.64. We think $860 is a reasonably safe entry point. The company pays $4.13 per share quarterly and an annual dividend of 16.52 cents per share, with an impressive yield of 1.91%. Its P/E ratio currently stands at 25.33. Number 4. Nvidia. This is yet another American multinational company founded in 1993 and headquartered in Santa Clara, California, USA. The chip giant Nvidia invented the graphics card, a specialized image processing processor popular with gamers and Bitcoin miners in 1999. Since then, its products have become an integral part of computer graphics, high-performance computing, and artificial intelligence. Advances in AI are transforming many industries, including transportation, healthcare, and manufacturing. Nvidia chips are therefore trendy. For the first quarter of the fiscal year in 2022, which for Nvidia includes February, March, and April of 21, it reported a doubling in net income and earnings per share. Nvidia shares have risen by 30% and reached their all-time high in June. The expected price-to-earning ratio is 42.7, which is quite substantial. But quality has its price, as investors are willing to pay for the company's growth prospects. After all, Nvidia's products are part of the global digital transformation we are currently experiencing. It generated revenue of $10.92 billion in 2020 and has already made $16.68 billion in revenue this year, 2021. The company pays out a dividend of 16 cents per share quarterly and an annual dividend of 64 cents per share with a yield of 0.08%. It currently has an impressive P/E ratio of 90.09. Number 5. General Motors. The American multinational company was founded in 1908 and headquartered in Detroit, Michigan, USA. The automaker General Motors is the market leader in the U.S. with brands such as Buick, Cadillac, Chevrolet, and GMC, and aims to bring 30 electric models to market within 5 years. The energy transition entails shifts that go beyond any economic cycle. General Motors is also suffering from the chip shortage, but posted a 3 times higher net result than in the previous quarter. It has an all-time high with an expected P/E ratio of 11. It generated $122.5 in 2020 and paid a 38-cent per share quarterly and an annual dividend of $1.52 per share. It currently has a P/E ratio of 9.76. Interested investors may want to consider buying in the dips. Number 6. Kellogg. Kellogg is a multinational food manufacturing company founded in 1906 and headquartered in Battle Creek, Michigan, USA. The cornflakes and Pringles maker posted 5.1% more net sales and 8.1% more earnings per share in the first quarter. The quarter was marked by accelerated growth in emerging markets, said CEO Steve Calhoun. The expected P/E ratio is 16.34, and investors looking for dividend stocks could put Kellogg on their radar. The company has enough cash in hand to potentially increase dividends and reduce debt in the coming years. The company generated $13.77 million in 2020. It paid out dividends of 58 cents per share quarterly, with an annual dividend of $2.32 per share, with a 3.63% dividend yield. It currently holds a P/E ratio of 17.33. Number 7. Lockheed Martin. This is an American aerospace, defense, information security, and tech company with a global interest. It was founded in 1995 after the merger of Lockheed Corporation with Martin Marietta. Lockheed Martin is an active in mainly military aerospace. Investment in innovation has been very high for decades. The company has long-term contracts with the Department of Defense. Lockheed Martin reported a 2.82% increase in net profit in its first quarter results. It expects earnings per share for the entire year at $26.55, up from $24.30 in 2020. The expected price-to-earning ratio is 14.39 and 1.62, and according to Investor Place, its revenue for March 2021 is $16.26 billion. It has an operating income of $2.33 and a net profit margin of 11.3%. The company pays out a dividend of $2.60 per share quarterly and an annual dividend of $10.04 per share, with a yield of 2.72%. It also has a current price-earning ratio of 15.42. An investment in Lockheed Martin stocks around these levels will provide significant long-term results. With this, we have come to the end of the video. Thank you for your audience, and let's continue the discussions in the comment below. See you at our next video.